Have you ever heard that debt is bad? Something to avoid at all costs? Well, it's not always that way. What few people know is that wealthy individuals use debt as a tool for building wealth. And if you understand this strategy, your financial life can change for good. Imagine discovering secrets that millionaires use to multiply their earnings, even when they're in debt. Today, we're revealing 5 surprising ways these individuals use debt to become even richer. And you can apply these same methods to achieve financial freedom and even retire earlier. Stick with me, because each of these strategies will show you the path to transforming your finances and building the security you've always wanted. After this video, you'll realize there are ways to make money work for you, not the other way around. If you want to understand how to turn things around, make sure you watch until the end. And before I forget, share your opinion in the comments. Have you ever used debt to invest or leverage your financial goals? Or do you have a specific question on the topic? Your experience or question could help others here who are learning and sharing ideas. Let's build a learning community together. Imagine an entrepreneur with a clear vision for growth, but who needs resources to expand. For many, taking on debt seems risky. But for major entrepreneurs, debt is a powerful tool for wealth creation. Instead of viewing debt as a burden, they use it to drive the business forward without committing all personal resources. This provides the business with more strength and competitiveness, especially in markets where innovation and expansion are constant. Let's consider the example of a small manufacturer looking to launch a new product line. Instead of using all capital on inventory, they take out a loan. This way, they can invest in marketing and a qualified team without depleting reserves. With this strategy, they grow without compromising the company's financial health and keep capital available for future opportunities. Another example is entering new markets. Small and medium-sized companies can now import supplies through platforms like Alibaba with deferred payment systems. This allows them to finance inventory and pay suppliers only after making sales. It's an approach that frees up cash flow and helps create a sustainable business cycle. In the coming years, this type of financing is expected to grow. With the expansion of fintech and new online credit options, entrepreneurs of all sizes will have more flexibility to access global markets and partnerships. Businesses that use debt strategically will be better positioned to withstand slow periods and take advantage of expansion opportunities. Successful entrepreneurs know that debt, when used intelligently, is not excessive risk, but an investment in the business itself. With planning, debt becomes a tool that maximizes return on investment. For example, short-term loans help increase inventory for seasonal peaks, while long-term financing enables expansions or the development of new products. This balance is essential to keep debt as a growth driver, not a burden. When thinking about starting or expanding your business, remember that debt, used strategically, allows you to focus on what really matters: growth and innovation, with cash flow under control and eyes on the future. Now that we understand how debt can leverage a business, let's see how this same approach is applied in real estate, where robust strategies enhance returns. In real estate investment, successful investors know that true potential goes beyond simply buying and selling properties. Many use refinancing to unlock the value of their properties without having to sell them, turning locked capital into new investment opportunities. With this technique, each property acts as a safe from which the investor can access funds when needed, accelerating asset growth without giving up the asset. The key to this strategy is market appreciation. For example, imagine an investor buys a property for $500,000, and after some renovations, the value rises to $700,000. With refinancing, they access this additional value by taking out a new loan based on the property's appreciation. This amount can be reinvested in new properties or other assets, keeping the original property in their portfolio. Here, refinancing doesn't represent uncontrolled debt increase, but rather a strategic use of assets to generate more return. Another significant advantage of refinancing is its tax benefit. Since the amount accessed is a loan and not profit, it's not taxed, and the interest on the new loan is deductible, further reducing the tax burden. In other words, refinancing allows access to capital without immediate tax costs, accelerating asset growth efficiently. This strategy is not just for those with multiple properties. Even homeowners of a single residence can use refinancing to free up resources, either for renovations that increase property value or to start new investments, like opening a business. In the US, this practice has become popular, turning property into a sort of personal bank to finance dreams and goals. Another interesting point is that the American real estate market offers the possibility of financing mortgages with terms of up to 30 years and stable interest rates, allowing investors to plan long-term with more security. Many take advantage of this stability to diversify freed-up capital into funds, stocks, and other sectors, creating a more robust and resilient portfolio. For rental properties, refinancing offers even more advantages. The investor can free up capital while continuing to generate income with the property, which can cover the new financing payment and, in many cases, still generate net profit. This way, the investor multiplies capital while maintaining a continuous cash flow, the so-called capital doubling, one of the great secrets of the most successful real estate investors. For those looking to expand in the real estate market and build wealth, refinancing is a fundamental piece that allows them to leverage property appreciation without halting growth. Now that we've seen how refinancing helps accumulate assets, let's move on to another fascinating strategy, short selling, which allows profits even in down markets. In the financial world, there's a powerful strategy that lets some investors profit even when the market is down: short selling. While most fear downturns, experienced investors, especially in hedge funds, see them as a profit opportunity. This strategy, widely used by those looking to accumulate wealth in all market conditions, lets investors take advantage of the downturn itself to multiply their gains. Short selling works in the opposite way to traditional investing. The investor borrows shares of a company they believe will lose value and sells them at a higher current price, expecting the value to drop soon after. When the stock price falls, they repurchase them at a lower price, return them to the lender, and keep the difference as profit. It's a strategy that requires careful analysis and a deep understanding of the market, since, if the stock value rises instead of falls, losses can be significant. Here, accurate forecasting defines success or loss. A practical example illustrates this. Imagine a hedge fund sells a stock at $100, expecting it to drop to $70. When the price falls, they buy it back at $70, making a $30 profit per share. This operation, generally carried out by professionals monitoring volatile sectors like technology, requires confidence and market knowledge. Although risky, it's one of the most profitable strategies in times of uncertainty, and when applied correctly, it becomes a powerful tool for generating income amid crises. In the coming years, the economic outlook is expected to remain challenging, with sectors in transformation and high volatility. This environment is ideal for short selling. Hedge funds are already positioning themselves to take advantage, analyzing overvalued companies or sectors likely to face adjustments. By 2025, for example, the tech sector, after a period of exponential growth, may undergo adjustments, offering unique opportunities for this type of investment. Anticipating these changes is the key to profiting from short selling. But short selling is not just an investment technique. It also works as a hedge for large portfolios. Hedge funds use this strategy to protect against declines in their assets, creating a kind of insurance against market fluctuations. This balance is fundamental to preserve and grow capital in adverse scenarios. This approach teaches an essential lesson: looking beyond highs and lows. Investors who master short selling know that every market movement, up or down, is an opportunity to build wealth. They see uncertainty as a field of possibilities and possess the confidence to navigate turbulent waters. This vision distinguishes common investors from successful investors. Short selling is undoubtedly an advanced technique, but for those who understand its risks and know how to apply it, it offers unique returns and a new market perspective. And now that we've explored how to profit from the downturn, let's look at another technique to amplify returns: leverage in the foreign exchange market, known as Forex. The Forex, or foreign exchange market, is one of the most dynamic and accessible environments for investors worldwide. In it, currencies from different countries are traded on a large scale, and leverage is one of the resources that makes Forex particularly attractive for those who want to amplify their returns. Leverage, simply put, is the ability to control a large amount of money with a relatively small investment. This amplifying effect is a powerful wealth-building tool for those who know how to use it strategically. To understand better, imagine an investor with $1,000. With a leverage of 100 to 1, they control a position of $100,000. Small variations in exchange rates can translate into significant gains, even with modest initial capital. In a transaction with a 1% appreciation, the profit can be substantial. But with big opportunities come big risks. The same movement can amplify losses, making it essential to use risk management strategies like stop-loss orders to avoid significant losses. Leverage offers a profit potential that's hard to find in other markets, but it's important to remember that it requires a disciplined approach. Experienced investors know that the secret lies in using only a portion of the capital in each trade and carefully following trends. With this, they protect their assets while taking advantage of the opportunities Forex offers, especially in a volatile interest rate environment, as predicted for 2025. Another advantage of Forex is the possibility of trading at any time of day, since the market operates 24 hours. This allows investors to react in real time to economic or political events that may influence the market, such as central bank announcements on interest rate changes. Those who anticipate these moves can capture profits by buying and selling currencies at the right time. In 2025, the foreign exchange market is expected to be particularly active, with possible fluctuations in interest rates and unexpected economic events. This scenario can create significant opportunities for investors attuned to global trends and who already have a well-structured leverage strategy. For those new to Forex, starting with a demo account is worthwhile to get used to leverage and understand currency behavior. Platforms like MetaTrader 4 offer valuable tools to simulate trades and test strategies, helping to build a solid foundation and avoid impulsive decisions. Forex is not just a market for quick profit, but also a strategic option for those looking to diversify their portfolio. When used with knowledge and caution, it can be an important component in the pursuit of financial freedom. And now that we've explored how leverage amplifies gains in Forex, let's see how the strategic use of credit can be another powerful tool for wealth creation. In the financial world, credit is much more than a score on a report. For the wealthy, it represents a strategic tool that facilitates access to low-cost financing, enabling investments and new acquisitions. A solid credit history opens doors to lower interest rates, which means more money in hand to invest and grow wealth. After all, the less paid in interest, the more resources remain available to build wealth. In a scenario where every percentage point counts, good credit is a real competitive advantage. Smart investors take advantage of low interest rates to maximize investment returns. Imagine a line of credit at 3%, used to invest in a business or property that yields 7% per year. The difference between the cost of debt and the return is direct profit, a logic that leads many to pursue an excellent credit score. With favorable rates, capital multiplies faster and debt becomes an ally in building wealth. Maintaining good credit requires discipline and planning. Paying bills on time, maintaining a positive history, and avoiding using the full credit limit are essential practices. These habits not only increase the credit score, but also expand financing options in the future, allowing the exploration of new investment opportunities without the burden of high interest. The result? A continuous cycle of financial growth. In the United States, where credit access is broad, having a solid history is a requirement for many opportunities. By 2025, with potential restrictions on credit criteria, a good score will be even more valuable. Financial institutions tend to offer advantageous conditions for those with strong credit, facilitating the purchase of properties, business expansion, and other long-term investments. Keeping healthy credit is, therefore, a way to be prepared when new opportunities arise. Using credit wisely is essential. Many end up taking on unnecessary debt, while experienced investors direct credit toward assets that generate returns. Imagine someone who takes out a low-interest loan and invests in a promising business. With growing income, the debt is easily paid off, and there's still profit left. This type of strategy distinguishes amateur investors from those who truly know how to build wealth. Moreover, credit also serves as a safety cushion. In times of crisis or unforeseen events, having a low-interest credit line available makes a big difference. This quick access to capital allows the investor to take advantage of immediate opportunities or keep their portfolio protected in uncertain times, acting as an extra emergency fund, and the best part, with favorable conditions. For those on the path to financial freedom, building and maintaining good credit is essential. It not only facilitates access to advantageous financing, but also enhances asset growth over time. Now that we've explored the power of credit to leverage investments, let's wrap up our journey with a broad view of the next steps and essential reflections to maximize these strategies. By now, you know the 5 strategies the wealthy use to turn debt into a wealth-building tool. Now, the most important thing is to put this knowledge into practice. What's the use of understanding the secrets of those who know how to build wealth if you don't start using them in your financial life? If you want to see real changes, you need to take action. Ask yourself, how can I apply one of these strategies starting today? Is it time to evaluate new ways of investing, or perhaps rethink how you view debt? When you understand that debt can be used intelligently, the path to financial freedom becomes increasingly clear and accessible. And if you're ready to take the next step on this journey, I'll leave a video here that's as important as this one. Click on it to keep learning and transform your finances even more. And of course, subscribe to the channel and activate notifications so you don't miss any content that can transform your finances.